Good day, Numbers Man here. This is a special report on the action of the Federal Reserve's Open Market Committee, and we'll briefly read their statement. And when we conclude our portion of the broadcast, we'll go to the news conference that Chair Yellen had on Wednesday, the 16th. Nonetheless, this is a special report from us, and on This Week in Economics, we'll be talking about one theory. One theory in particular. Here we'll be talking about data-driven, which we are going to rely upon an article at the Brookings there, and the Phillips curve and how it relates to inflation and unemployment, and is it relevant today. But let me just read this statement here. Incidentally, this is on the 17th of December 2015. This was released by the Board of Governors of the Federal Reserve on the 16th of December 2015. Information received since the Federal Open Markets Committee met in October suggests that economic activity has expanded at a modest pace. Household spending and business fixed investment have been increasing at solid rates in recent months, and the housing sector has improved further. However, net exports have been soft. A range of recent labor market indicators, including ongoing job gains and decline in unemployment, shows a further improvement and confirms that the utilization of labor resources has diminished appreciably since early this year. Inflation has continued to run below the committee's expectation, the magic bullet of 2% long-run objective, partially reflecting declines in energy pricing and in pricing of non-energy imports. Market-based measurements of inflation compensation remain low. Some survey-based measurements of long-term inflation expectations have edged down. Consistent with the statutory mandate, the committee seeks to foster maximum employment and price stability. The committee currently expects that with gradual adjustments in the stance of monetary policy, economic activity will continue to expand at a modest pace. Labor market indicators will continue to strengthen. Overall, taking into account domestic and international developments, the committee sees the risks to the outlook for both economic activity and the labor market as balanced. Inflation expected to rise to 2% over the midterm as transitory effects of decline in energy and import prices dissipate. The labor market strengthening further, the committee continues to monitor inflation development closely. The committee judges that there has been considerable improvement in the labor market conditions this year, and it's reasonably confident that inflation will rise over the medium term to its 2% objective. In other words, what goes up comes down. Given the economic outlook and recognizing the time it takes for policy action to affect further economic outcomes, the committee decided to raise the target rate for the federal funds to 1/4 to 1/2%. The stance of monetary policy remains accommodative after this increase, and therefore supporting further improvement in labor market conditions and return to 2% inflation. In determining the timing and size of future adjustments to the target range for the Fed's fund rate, the committee will assess realized and expected economic conditions relative to the objective of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressure, inflation expectation, and reading on the financial international developments in light of the current shortfall of inflation from the 2%. The committee will carefully monitor actual and expected progress towards its inflation goal. The committee expects that economic conditions will evolve in a manner that will warrant only gradual increase in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the long run. However, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. The committee is maintaining existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage securities back into agency mortgage-backed securities and rolling over maturing treasury securities at auctions. It anticipates doing so until normalization of the level of federal funds rate is well on the way. This policy, by keeping the committee's holdings of long-term securities at a sizable level, should help maintain accommodative financial conditions. It's signed by Chair Yellen, Dr. Dudley, Bernard, Evans, Dr. Fisher, Lacker, Lockhart, Powell, Torello, and John C. Williams. So you have the story, and in the conference, Chair Yellen, Dr. Yellen, talked about accommodative economic policy. And I was just looking at the Reuters headline here, kind of interesting. Reuters being an information financial / outlet. Confident and clear, Yellen says rate path will be well signaled. Now, there had been some controversy by some on Wall Street, but it's not well signaled by the Fed, lack of communications or whatever. But the problem here is that the economy itself, economic conditions, are not linear. They're not in a straight line. They are more in tune with our seesaw model. They are ups, they're downs. The ever-integrated international economy has taken on significance on the American economy. So when you hear basically the communications in terms of how normalization will occur, what the markets are talking about is the good old days, and that will not occur. Let me just get a little more of this. Confident Yellen measured performance. She even managed a joke about the Fed's forecasting record. Came at the end of the extraordinary measures that revived the economy, the U.S. economy, from the worst recession since the 30s. We term that a depression. Clear communication has not been a strong suit. You have to look at these articles, and the one in Reuters here by Ann Shapler, I suppose, is editorializing at its best. The communication has not been as good. Part of the problem is you cannot communicate a clear path on a crooked highway, winding highway, as I think Dr. King once said in a speech when he was going from Jerusalem down to Jericho. It was down to Jericho. Anyway, nonetheless, the path is winding. There are no doubt about that. And the Fed's policy, where to some would seem that it is not consistent, is consistent with the conditions under which the Fed works. The quarter to half point rise over the long term. So those are to be there. But what is expected from Wall Street is a perfect picture. The study of economics and particularly economic modeling has never been a perfect picture. Perfection is not there. There's a sort of an American phenomena that expects a perfect world, where there is no such thing as a perfect world. And in economics, obviously there is not. A crisis can occur today, tomorrow, next week, or next month, but we'll throw these models off. the models can simulate many things, as we do with our models, and more getting into predictive models like R. Won't get into that here, but looking at things. But even the predictive models, the newer models, are not perfect. In fact, they can be totally wrong. And that is one of the things you expect working in econometrics over any time period. And there was some mention there by someone, an academic economist. Well, academic economists are a little bit different in that they are given the latitude to theorize there in an academic environment. But there's very little difference these days, at least as far as models, what academic economists do, unless they're still stuck back with Adam Smith. Now, obviously, depending on which school they cover, I don't want to go too much of that. The Chicago school and Midwest school, much more conservative economists there, as opposed to where Jerry Yellen is from, the West Coast of Berkeley types that are more realistic as to where they are going. And the neo-Keynesians and other kinds of economists out there look at things a little bit differently. But no matter from which perspective they come, they have to look at the data as it is presented to them. In other words, the rate of redundancies or unemployment, the rate of inflation. They can argue about, well, okay, this is the actual rate here, or you get to the actual rate of unemployment, job participation. Well, yeah, job participation for the last decade has been stagnant, and there are a number of reasons, and we've talked about it here. And then we go to what we'll be talking about on This Week in Economics coming up on Saturday, the Phillips curve and its relation to unemployment and inflation. And we'll see where we tend to go there. But the Fed will continue to be accommodative. Let me just close this out with a Brookings article here, what the Fed really means when it says interest rates rises are data dependent. And this is by where'd he go here? David Weissel and Peter Olson. For the past year, the Fed Policy Committee, that's the Open Market Committee, has described the timing of its much anticipated move, which it made yesterday, to raise interest rates as data dependent, or some variation there. What exactly does that mean? Does the phrase actually convey how the Fed is thinking about the economy and interest rates? Chair Yellen went into this today as transitory, and suggested that the introduction of the phrase, this was in 2014, as the express goal of keeping the markets from growing complacent. In June, some of the Fed members expressed concern that low implied volatility in equities, currency, and fixed income markets indicated that market participants were not factoring in sufficient uncertainty about the path to the economy and monetary policy. In short, Fed officials thought their forecasts about future path interest rates were being taken too seriously, most likely comments than predictions. They agree that the committee should emphasize in its communications the dependence of policy decisions on the evolution of economic outlook. Now, Charles Posner, who used to be at the Fed in Philadelphia, described the path of an emphasis on data dependency. He objected to the Fed's statement that interest rates would remain near zero for considerable time, and argued that the reference to calendar time should be replaced with language indicating how monetary policy will respond to incoming data. The minutes revealed an unnamed participants, of whom Posner was almost certainly one, suggesting that the guidance should more clearly communicate how policy settings would respond to the evolution of data. Chair Yellen, of course, the timing of the first increase in the federal fund rate and its subsequent path will be determined by the committee in light of incoming data. The phrase figures more prominently than in talk of economic outlook. This is you're hearing her presentation talking about mechanically driven, data-driven / mechanically driven, computer-driven, what do you want to call it. Some believe this distinction is not significant. Data outlook is all the same. Others, including Brookings' colleague David Horn, a former Fed vice chair, thinks the choice of words matter. Outlook seems more inert and future-based. The outlook rarely changes dramatically based upon a single economic report, whereas talk by the Fed members of decision-making process being data-dependent, combined with hints that the Fed is particularly interested in a given economic indicator upon release, could imply that the newest indicator has outsized influence. Well, Chair Yellen, like many others, has her her indicator on the desktop, so to speak. Let me get down here. John Foss, he's at the Johns Hopkins University, former advisor to Chair Yellen, also agrees the phrase sometimes makes it seem as if the FOMC is saying we are on the edge of our seats all the time and about ready to tip one way or another. Well, that is the meaning of transitory. The need to communicate more effectively, that is outlook dependent, and the outlook for a year to 3 years in the future changes rather gradually. Well, it doesn't necessarily do today. So it is affected by the employment report, etc. Well, you need to look at employment reports, first of all, over a number of weeks. The Fed is trying to convey a message more subtle than the markets, the press, and the politicians can absorb. If the economy evolves as we expect, we are going to raise interest rates soon, but the prediction depends upon how the economy evolves. That is definitely a factor, because how the economy evolves is what you get from your data, no doubt. If the economy surprises us, that's what they meant by transitory, and outlook for unemployment and inflation changes, then don't complain and we don't raise interest rates as soon as you expect. The Fed has a great deal of experience distinguishing between the signal from the noise, and that's a book by none other than Nate Silver, and it goes back to economic forecasting in particular. The theory involved in econometrics. Won't go into that much. We'll do a little bit on Friday. On Saturday, we'll talk more about the technical aspects with the Phillips curve and what we mean by signal there, and several other things. What I was thinking of with Chair Yellen, that's the infamous dashboard. That's something that's become quite common in the computer age, particularly with the commercial term called cloud computing, that executives have, quote unquote, the desktop. That was the whole idea behind the iPod. You have a desktop there, a dashboard, excuse me. You have a dashboard there which has all these indicators. You could have 3, 4, 5 indicators there, and perhaps we'll have another interesting little thing. It'd be a surprise that we found on the web a gentleman that has worked on this for 30 years, and very interesting visualization of data and how he has done it. We'll definitely do it here on iHeart Spreaker as we are here today. Nonetheless, that'll do it for us. On to Dr. Yellen and her report and the news conference. A question and answer, give and take there. The Wall Street Journal was there, the Financial Times was there, Marketplace was there, a bunch of economic type journalists. However, though, the number of people of color in the audience was sparse at best, so we'll add a little color to the commentary here. This is Numbers Man. We'll see you this weekend, and we invite you to listen to our programs on the Bostonred Network WBRN radio, as we present Bostonred, our political program, and the Open Source Report, our technical program that one aired earlier this week. Do tune in to it. And as we modernize our collective portal called Bostonred.org, where you can find this information, and also in our programs, we have program notes that are links to many of the things we report on. Good day.
Good afternoon. Earlier today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/4 to 1/2%. This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero to support the recovery of the economy from the worst financial crisis and recession since the Great Depression. It also recognizes the considerable progress that has been made toward restoring jobs, raising incomes, and easing the economic hardship of millions of Americans. And it reflects the committee's confidence that the economy will continue to strengthen. The economic recovery has clearly come a long way, although it is not yet complete. Room for further improvement in the labor market remains, and inflation continues to run below our longer-run objective. But with the economy performing well and expected to continue to do so, the committee judged that a modest increase in the federal funds rate target is now appropriate, recognizing that even after this increase, monetary policy remains accommodative. As I will explain, the process of normalizing interest rates is likely to proceed gradually, although future policy actions will obviously depend on how the economy evolves relative to our objectives of maximum employment and 2% inflation. Since March, the committee has stated that it would raise the target range for the federal funds rate when it had seen further improvement in the labor market and was reasonably confident that inflation would move back to its 2% objective over the medium term. In our judgment, these two criteria have now been satisfied. The labor market has clearly shown significant further improvement toward our objective of maximum employment. So far this year, a total of 2.3 million jobs have been added to the economy, and over the most recent 3 months, job gains have averaged an estimated 218,000 per month, similar to the average pace since the beginning of the year. The unemployment rate at 5% in November is down 0.6 of a percentage point from the end of last year, and is close to the median of FOMC participants' estimates of its longer-run normal level. A broader measure of unemployment that includes individuals who want and are available to work, but have not actively searched recently, and people who are working part-time but would rather work full-time, also has shown solid improvement. That said, some cyclical weakness likely remains. The labor force participation rate is still below estimates of its demographic trend. Involuntary part-time employment remains somewhat elevated, and wage growth has yet to show a sustained pickup. The improvement in employment conditions this year has occurred amid continued expansion in economic activity. U.S. real gross domestic product is estimated to have increased at an average pace of 2.25% over the first 3 quarters of the year. Net exports have been restrained by subdued foreign growth and the appreciation of the dollar. But this weakness has been offset by solid expansion of domestic spending. Continued job gains and increases in real disposable income have supported household spending, and purchases of new motor vehicles have been particularly strong. Residential investment has been rising at a faster pace than last year, although the level of new home building still remains low. And outside of the drilling and mining sector, where lower oil prices have led to substantial cuts in investment outlays, business investment has posted solid gains. The committee currently expects that with gradual adjustments in the stance of monetary policy, economic activity will continue to expand at a moderate pace, and labor market indicators will continue to strengthen. Although developments abroad still pose risks to U.S. economic growth, these risks appear to have lessened since last summer. Overall, the committee sees the risk to the outlook for both economic activity and the labor market as balanced. The anticipation of ongoing economic growth and additional improvement in labor market conditions is an important factor underpinning the committee's confidence that inflation will return to our 2% objective over the medium term. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, was only 0.25% over the 12 months ending in October. However, much of the shortfall from our 2% objective reflected the sharp declines in energy prices since the middle of last year, and the effects of these declines should dissipate over time. The appreciation of the dollar has also weighed on inflation by holding down import prices. As these transitory influences fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the medium term. The committee's confidence in the inflation outlook rests importantly on its judgment that longer-run inflation expectations remain well anchored. In this regard, although some survey measures of longer-run inflation expectations have edged down, overall they've been reasonably stable. Market-based measures of inflation compensation remain near historically low levels, although the declines in these measures over the past year and a half may reflect changes in risk and liquidity premiums rather than an outright decline in inflation expectations. Our statement emphasizes that in considering future policy decisions, we will carefully monitor actual and expected progress toward our inflation goal. This general assessment of the outlook is reflected in the individual economic projections submitted for this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy. Participants' projections for real GDP growth are little changed from the projections made in conjunction with the September FOMC meeting. The median projection for real GDP growth is 2.1% for this year and rises to 2.4% in 2016, somewhat above the median estimate of the longer-run normal growth rate. Thereafter, the median growth projection declines towards its longer-run rate. The median projection for the unemployment rate in the fourth quarter of this year stands at 5%, close to the median estimate of the longer-run normal unemployment rate. Committee participants generally see the unemployment rate declining and then leveling out. The path of the median unemployment rate is slightly lower than in September. And while the median longer-run normal unemployment rate has not changed, some participants edge down their estimates. Finally, FOMC participants project inflation to be very low this year, largely reflecting lower prices for energy and non-energy imports. As the transitory factors holding down inflation abate and labor market conditions continue to strengthen, the median inflation projection rises from just 0.4% this year to 1.6% next year and reaches 1.9% in 2017 and 2% in 2018. The path of the median inflation projections is little changed from September. With inflation currently still low, why is the committee raising the federal funds rate target? As I've already noted, much of the recent softness in inflation is due to transitory factors that we expect to abate over time, and diminishing slack in labor and product markets should put upward pressure on inflation as well. In addition, we recognize that it takes time for monetary policy actions to affect future economic outcomes. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly at some point to keep the economy from overheating and inflation from significantly overshooting our objective. Such an abrupt tightening could increase the risk of pushing the economy into recession. As I've often noted, the importance of our initial increase in the target range for the federal funds rate should not be overstated. Even after today's increase, the stance of monetary policy remains accommodative, thereby supporting further improvement in labor market conditions and a return to 2% inflation. As we indicated in our statement, the committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. This expectation is consistent with the view that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy were operating near potential, is currently low by historical standards and is likely to rise only gradually over time. One indication that the neutral funds rate is unusually low is that U.S. economic growth has been only moderate in recent years, despite the very low level of the federal funds rate and the Federal Reserve's very large holdings of longer-term securities. Had the neutral rate been running closer to its longer-run level, these policy actions would have been expected to foster a much more rapid economic expansion. The marked decline in the neutral federal funds rate may be partially attributable to a range of persistent economic headwinds that have weighed on aggregate demand. Following the financial crisis, these headwinds included tighter underwriting standards and limited access to credit for some borrowers, deleveraging by many households to reduce debt burdens, contractionary fiscal policy, weak growth abroad coupled with the significant appreciation of the dollar, slower productivity and labor force growth, and elevated uncertainty about the economic outlook. Although the restraint imposed by many of these factors has declined noticeably over the past few years, some of these effects have remained significant. As these effects abate, the neutral federal funds rate should gradually move higher over time. This view is implicitly reflected in participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises gradually to nearly 1.5% in late 2016 and 2.5% in late 2017. As the factors restraining economic growth continue to fade over time, the median rate rises to 3.25% by the end of 2018, close to its longer-run normal level. Compared with the projections made in September, a number of participants lowered somewhat their paths for the federal funds rate, although changes to the median path are fairly minor. I'd like to underscore that the forecasts of the appropriate path of the federal funds rate, as usual, are conditional on participants' individual projections of the most likely outcomes for economic growth, employment and inflation, and other factors. However, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. Stronger growth or a more rapid increase in inflation than we currently anticipate would suggest that the neutral federal funds rate was rising more quickly than expected, making it appropriate to raise the federal funds rate more quickly as well. Conversely, if the economy were to disappoint, the federal funds rate would likely rise more slowly. The committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As highlighted in our policy statement, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that the federal funds rate might return to the effective lower bound in the event of future adverse shocks. Finally, policy statement, we also released an implementation note that provides details on the tools that we are using to raise the federal funds rate into the new target range. Specifically, the Board of Governors raised the interest rate paid on required and excess reserves to 0.5%, and the FOMC authorized overnight reverse repurchase operations at an offering rate of 0.25%. Both of these changes will be effective tomorrow. To ensure sufficient monetary control at the onset of the normalization process, we have, for the time being, suspended the aggregate cap on overnight reverse repurchase transactions that's been in place during the testing phase of this facility. Recall that the committee intends to phase out this facility when it is no longer needed to help control the federal funds rate. The Board of Governors also approved a 0.25 percentage point increase in the discount rate for primary credit to 1%. Based on the extensive testing of our policy tools in recent years, the committee is confident that the normalization process will proceed smoothly. Nonetheless, as part of prudent contingency planning, signals the FOMC's confidence that conditions will continue to strengthen and job market prospects will be good. It is a very small move. It will be reflected in some changes in borrowing rates, longer-term interest rates, loans that are linked to longer-term interest rates are unlikely to move very much. For example, some corporate loans are linked to the prime rate, which is likely to move up with the Fed funds rate, and those interest rates will adjust. There are some consumer borrowing rates, I think credit card rates that are linked to short-term rates that might move up slightly. But remember, we have very